Listen, if you build a startup and one day you sell it, taxes can take a big bite. But here's one rule that can make that bite way smaller on the federal side, sometimes even close to zero on a big chunk. The rule is called QSBS. And here's a new twist. A new law called One Big Beautiful Bill Act made the QSBS stronger for new stock purchase after July 4th, 2025. So it did three big upgrades. It raised the max tax-free cap for new stock from $10 million to $15 million. It made the small company limit bigger from $50 million to $75 million in assets. And it added a step system so you can get some benefit sooner. You don't have to wait 5 years to get the capital gain exclusion. So QSBS is like a golden ticket. If you earn the ticket early and you follow the rules, the government may not tax you a big part of your profit when you sell it. Now, let's make that simple, easy, plain English. Rule number one, your company must be a C-corp, non-LLC. Now I'll switch later. It has to be a C-corp from the start. Rule number two, you must get the stock from the company itself, like founder shares or early employee shares, not buying shares from another person later. Rule number three, the company must be small enough. So when the stock is given to you with the new law, new stocks can qualify for up to $75 million in assets instead of $50 million. That means more startup fit now. Rule number four, the company must be a real working business. So a real product, real service, real estate tech can fit, property tools can fit, data tools, smart home tech, but plain real estate investing usually doesn't fit. So don't assume, always check early. Rule number five, you must hold the stock long enough. This part actually got better with the new law. So for new stock after July 4th, 2025, there is a step system. So if you hold a stock 3 years, you may exclude up to 50% of the allowed gain. If you hold it for 4 years, you get up to 75% exemption or exclusion. You hold it for 5 years, that's the winning number. You may exclude up to 100% of your capital gain, up to the limit. Rule number six, there is a cap. So for new stock, the cap can be up to $15 million of gain that may be tax-free on the federal side. Still, that's a huge number, life-changing numbers. Now, I'm going to be blunt to tell you that QSBS is not a do-it-later thing. It's a do-it-early thing. If your setup is messy, this will fall apart. If your stock are not issued clean, this may make you disqualified. If your records are trash, that can also fall apart. Why I'm saying that? Because I see that all the time. Founders build fast, they sell, they raise money, they focus on clients. Love that. But they ignore the legal boring stuff. Then they get an offer to sell and they find out the golden ticket is missing. Let me give you a simple case study. Say you build a property management app or AI app and real estate tech company, one of these services that qualify for QSBS. You set it up C-corp on January 1st, 2026. And on that day, the company gives you founder shares. So clean records, clean stocks, and you grind for 3 years, you grow, you get real clients, you build a real team, and January 1st, 2029, a bigger company buys you. Let's say your profit on the stock is $20 million. Without QSBS, that profit can get hit with the federal tax, big check to the IRS, and that's not fun. But with the QSBS, if you qualify, you may be able to protect part of that gain from the federal tax. And because of the new law, if your stock is new kind, you might get a real break even at year 3. So here's how this could look like in plain English. The new cap is up to $15 million of new stock. At year 3, the step system can allow 50% exclusion. So up to $7.5 million of the gain could be tax-free on the federal side. At year 4, it can be 75% of the cap. At year 5, and that's always the winning number, it can be 100% exclusion of the capital gain up to that cap. Is it always like that? No, but don't be sloppy. There are rules, but that's the big idea. The new law made the QSBS bigger and faster for new stocks. Now, the part nobody likes, this is federal. States are different. So we live in California. California often doesn't play nice with the QSBS. So yes, you might win big on the federal side, but California still tax you on that gain. I know it's annoying, but that's the game. So here's what I want you to do this week. If you think you may qualify for QSBS, first, check what you are now. Are you structured as an LLC, C-corp? Don't guess. Make sure you are a C-corp. If you are, then you know you qualify. Second, if you're raising money soon, bring up QSBS before the round closes, not after. After is too late. Third, clean your equity stuff. You know, your cap table, stock docs, approvals, the boring basics. This is what protects the win. That's it. QSBS is a golden ticket, but don't get it by luck. You get it by doing the boring legal steps early on and plan for it. I hope that was helpful. Thank you for spending time with me. I hope to see you in the next episode.
This has been another episode of our tax saving video series. If you enjoy this video, please like it, subscribe below, and share with other business owners. You can find previous episodes and more information at www.bostacpa.com. Thanks for listening, and have a great day.